Hi, everyone. I want to welcome you to this week's episode of the HX podcast. Today, we're going to have a great guest. His name is JC Parets. He's a fantastic technical analyst from All-Star Charts. He does absolutely great work using technical analysis to identify opportunities in the stock market and other assets. And, one thing I really love about the work that he does is it's very approachable. It's not crazy technical. It's very easy to understand. So I would encourage you to check that out. And he's going to join us here in a couple minutes. I wanted to start by talking a little bit about what's happening out there in the stock market right now. And I want to talk about a particular topic that is getting a lot of time right now on CNBC and everywhere else. And that is the underperformance of the small capitalization stocks. Now, you've probably heard a lot about this, mostly in the context of people are arguing that this is very bad for the health of the stock market. And the argument goes that when small caps are underperforming this poorly, it means that whatever gains we're seeing in the overall stock market are vulnerable. That while we're making money today and the markets are up a lot, they could sell off at any moment. Now, sure, that's always true, but is the performance of the small caps really that big of an issue for the market? Let's go through a couple points here. The first is, what is the performance of the small caps? So I have here some data. In the last year, the S&P 500 is up 23%. That's the 500 stocks. That's probably the best barometer of the stock market. The NASDAQ 100 is up 36%. That's the tech stocks, growth stocks, also a good barometer, but obviously a lot more growthy. And the Dow Jones Industrial Average, which has 30 large cap stocks that are meant to capture the performance of the overall economy, is up about 14%. The Russell 2000 is up 5% during that period. Now, what is the Russell 2000? There's an analytics firm out there called Russell that they compile these indices, custom indices that they put together. There's one called the Russell 1000, which is the largest stocks out there, the top 1,000 market cap in the U.S. There's one called the Russell 3000, which are the top 3,000. And the Russell 2000 is simply the next 2,000 largest or smallest companies that are listed publicly in the United States. So again, the Russell 2000 is up 5. These others are up 20 to 30%. Let's talk a little bit about the size of these, because it's important to understand what the size differential is. The average market cap in the S&P 500 is 80 billion. The average market cap in the NASDAQ 100 is 170 billion. And the average market cap in the Dow Jones Industrial is 400 billion. Remember, the Dow Jones is supposed to really capture the biggest stocks. The average market cap of the Russell 2000 is just 3 billion. So when you look at the Russell 2000, it only makes up about 7% of the market cap of the Russell 3000. My point is that when you look at the small cap underperformance, we're really only talking, even though it's 2,000 stocks, we're really only talking about stocks that make up about 7% of the overall broader stock market. Now, let's compare and contrast that to the largest component, or depending on the day, second largest component of the S&P 500, which is Apple Inc. Apple makes up about 6.5% of the S&P 500. So when you look at it, the market capitalization of Apple is actually greater than the market capitalization of all 2,000 of these stocks. That's absolutely crazy. So we have all this angst about these 2,000 companies, but from a market cap perspective, it's smaller than Apple. What's more interesting is that if we actually look at the earnings of Apple and the Russell 2000, Apple earns about 90 billion of net income per year. The Russell 2000 earns closer to 80 billion. So I just want this to sink in. We've got this index that everyone talks about, makes a big deal out of. It's got 2,000 companies, but on a market cap and earnings basis, it's smaller than just Apple. So how much should we care about the Russell 2000? Well, let's go do an analogy. If Apple did poorly and it is one of 500 stocks in the S&P 500 and represents about 7% of the market cap, there are still 499 stocks to make up for the performance of Apple. So I would make the same analogy with the Russell 2000. Yes, it's 2,000 companies, but it's only 7% of the market cap of the indices of the Russell 3000, the broader stock market, and that means there's 93% of the market cap of the Russell 3000 to make up for if these companies are struggling. So, one of the things I'm looking at my notes here, I apologize. One of the things that I then think about is, well, okay, these are 2,000 companies. Don't they matter? Don't they impact the economy? And yeah, Apple's just one company. It's a big company and all that. Or is the performance of the Russell 2000 telling us something about the economy that we should be worried about? And here's some other interesting numbers. The Russell 2000, again, it does about 80 billion of net income, does 2 trillion of revenue. That is against 27 trillion of gross domestic product or GDP in the United States. That means, drum roll, that the Russell 2000 represents, and this is a proxy, it's not exactly apples to apples, the Russell 2000 represents about 7% of the total economy. So what we're talking about here is what the market is signaling to us is that this group of smaller companies, 3 billion market cap, is underperforming the overall economy, and it makes up about 7% of the economy. So again, I'm concerned, but I'm not crazy concerned because it's 7% of the economy. The majority of the jobs, the majority of the economic production come out of much larger companies, and by the way, much smaller companies. But let's go through one thing. I had a conversation on Twitter. You can follow me at Enrique Abeta on Twitter X with my good friend Keith McCullough, and he was making a point about the small caps. And I basically argued it shouldn't be a surprise that the small caps kind of suck. These are smaller companies that are subject to competition from companies like Apple and Microsoft and these huge companies that have a ton of cash and a ton of scale. They are more subject to input costs, meaning that, an increase in the price of copper and wood, any of these inflationary things impact them. But most importantly, they're more impacted by higher interest rates and how interest rates have moved higher so quickly. Just imagine, you have a smaller company, you don't have as much cash on the balance sheet, your ability to get financed, your cost of financing, it's all higher. So, when we look at the fact that the Russell 2000 is underperformed, economically, these companies probably also are underperforming when you really think about it. And, I want to put one more thing about that difference between the ability of the large caps and the small caps. If you took the cash on the balance sheet of Apple, Microsoft, and Google, 3 of the 4 largest companies in the stock market, they have 400 billion of cash on their balance sheets. That is equal to almost 20% of the market cap of the entire Russell 2000. So it's not a surprise that these stocks have sucked. One final thing I'll say, when you go through the conversation that we had with JC, he points out that the Russell 2000 also has very large exposure to some very small groups. To energy stocks, makes up a bunch of them. Biotech stocks, companies make up a bunch of them. Regional banks. So I don't really think the Russell 2000 is a good proxy for market health. And there have been long periods, decades, where the Russell 2000 has underperformed the S&P 500. So let me come back to this final thing. Look, I hope the Russell 2000 kicks ass. I hope it goes to new highs. I think that'd be great for those companies. It's great for the economy. It's great for the market as a whole. But I would not take the underperformance of the Russell 2000 as a major red flag in the stock market today. Maybe it's a yellow flag. Maybe it's a soft yellow flag. But, something to think about. And it gets to the point. You hear a lot of things on CNBC. You hear a lot of things on social media about people talking about these things to be worried about. But do the work. Dig into the data, understand the impact, and ultimately it's going to make you a better investor. So with that, let's get to our conversation with JC here. Again, thank you for joining us on the HX podcast, and let's go make some money. First off, JC, I want to say thanks for joining us, and how you doing today?
I'm doing great. Thanks for the invite. I appreciate this. Sit back, chat about market life. I like it.
Yeah, absolutely. What maybe be useful for our audience, and actually for me, we've spoken a little bit. Tell me a little bit about your background and how you got into technical analysis, the markets, et cetera. I mean, I think you and I actually share a reasonable amount of similar background, being, children of Latin immigrants and all that stuff. So.
Yep, that's right. My family's from Cuba. They were born there. I was the first one born in the United States. So, a Cuban kid in Miami, played baseball, if you can imagine that. So, a curveball got me into a better school than maybe my grades would have gotten me into. I had decent grades, but I didn't have Fairfield University grades. It's a good school. It's tougher to get into now.
Can I actually ask you something? Can I
Sure.
ask you something? Fairfield's had a couple really great baseball players, haven't they? I feel like there were a couple guys I saw drafted. Who are the really good baseball players out of Fairfield?
I wasn't one of them.
Okay,
Listen,
yeah.
When I was at Fairfield, we got worse every year I was there.
Okay, not because of you, obviously, but
no, they made it. They made it far into the tournament more recently. They really turned up that program. These kids, they're getting kids drafted every year.
Okay.
I wasn't one of those. But shout out Fairfield Stags. Keep up the good work. But what that really did, we didn't talk about the market at the dinner table. My parents were into other things. But a lot of my friends in college, that was discussed at the dinner table. Friends from Long Island, friends from Connecticut, Westchester, New York, all these things, New Jersey. They all had grandfathers, fathers, uncles, somewhere in the business. I didn't have that. So, I interned at Merrill Lynch when I was in college and, felt it was love at first sight for me in the market. I knew I wanted to live in New York City and, started learning about the market and trading. And, that was for me, early on. So I was a retail broker early on, kind of just, working for, money managers and kind of just doing whatever they asked and things like that. And, I quickly learned that I needed to learn something, and I didn't know how to make money in the market. But what's scary is that there were people twice my age, 3 times my age in some cases, and they didn't know what they were doing either. So I was like, whoa, I don't want to end up like that. So I was like, all right, so I got to learn something. So when I go get a master's, that's not really for me. Do I get a CFA and learn about companies, or do I get my CMT and learn about stocks and trading and, intermarket relationships? And, little did I know what an impactful decision that would be to go the technical analysis route, right? As Yogi Berra said, when you hit a fork in the road, take it.
Right.
So that's what I did with technical analysis. And very quickly, 2008 came around and was a difficult year for a lot of investors. It was the best year I ever had.
Yeah.
For a long time after that, in fact, and that was a blessing and a curse. The blessings like, okay, hey, this technical analysis stuff really works. The curse was when you're that young and you've got all these people that are older than you telling you how great you are and how smart you are and all these things, it starts getting to your head. And it took me years to overcome that because, those feelings that you have, at such a young age and calling it right and nailing the big crash, what happens after that? You want to nail the next big crash.
Right.
So I'm always looking for the next big one. And, that's the opposite of what we need to be doing as investors. And that was very foolish.
The reality is the business is more grinding and like figuring out how you can hit singles and doubles as opposed to home runs.
That's right.
To really create a sustainable career. So continue, and then I'm going to give you the similarities between you and I because I think they'll scare you. So.
Yeah, and it took me until like 2012 to really even 2013 to realize, JC, you got to stop fighting trends.
Yeah.
You like this isn't sustainable. Like trends persist, and that's why at the end of the day, why technical analysis works, because asset prices trend. We know that. We have the data. Like we know asset prices trend. So if as investors, it makes sense to spend a lot of time looking for trends. So I started a hedge fund in 2012. It was a startup, was trying to just kind of raise assets. And, I had a lot of people that were trying to tell me because I was sort of publishing. I had a blog at the time called All-Star Charts, from like 2011. But that was just that. It was just a blog. So a lot of people were trying to get me to fulfill more research because I was doing it anyway for the assets that I was managing. So I was like, all right, if nobody buys it, I still have to do the work.
Yep.
So, all right, let's see if I can make an extra few bucks to help pay for the bills of running a general partnership on Fifth Avenue in New York City in my late 20s, right? It ain't cheap. And then an apartment and the whole thing, right? Things are expensive. All right, let's see if we can make an extra couple of bucks. Well, as it turns out, I started making millions of dollars. And I remember being in Napa Valley with my wife, my girlfriend at the time, and, I was getting killed in bonds. I don't know what interest rates were doing. I was getting killed. I'm in Napa Valley. I can't even eat. I'm on Washington Street in Yountville. And if you can't eat there, like something's wrong with you. It's like some of the best food on the planet, right? And I'm just like, and I remember like thinking like, what am I doing? Like, why, all the runaround with raising assets and dealing with LPs and, all the compliance stuff and Cayman Islands this and the Washington Trust that. And it's like a never ending headache. Meanwhile, all this revenue's coming in from, this unfinished product of a publishing business that I had sort of accidentally.
Yeah.
It's like, what am I even doing? So my girlfriend and I, we moved to California. It's like, all right, why don't we focus on building out the research company for a couple of years, then we'll move back to New York, relaunch the fund, and now we have a real business as opposed to sort of an unfinished product. Well, 2 years in California turned into 5 years because California is awesome, and ended up selling the company, the research company, a couple of years ago to a fintech firm called Tiffin out in Boulder, Colorado. And now, I spend the majority of my time managing my own wealth and, working on some things to build out more research. Because, what I found now, with the wealth that I've accumulated is that, we can essentially, the team that I have, the analyst team that I have, their salaries are essentially covered by subscriptions that we're selling, like the research that we're allowing other people to see. And those are the guys that are helping me manage my own portfolios. Okay, nice. So I don't have to pay their salary. So it's kind of like, this whole thing is working out pretty well. So that's sort of the long story.
So let me give you three similarities that are kind of eerie, and then I want to talk about technical analysis and what it really means. The first is you joke about your parents didn't really talk about stocks. I joke about like my family didn't know much about stocks, but they knew a lot about bonds. But they were bail bonds. So it's literally the closest we ever got to a security. I started my first hedge fund when I was 27 or 28. 3 years later, we were like the 87th largest hedge fund in the world. And I've been working off of that or correcting some of the success that I had 25 years ago since then, because it does put you in an interesting situation where you have that success so quickly, you kind of have to unlearn things. But then finally, my journey, I left the active management side in 2016. In 2019, my old friend Whitney Tilson said he was going over to do a newsletter over at Stansberry with Porter Stansberry, who's a fucking legend. And I was just like, newsletters, I don't even know what the hell you're talking about. What is this? And I looked at it and I was like, and I think you're probably going to feel the same way. I loved managing money. I still love managing money, all that. Two things, raising money was a pain in the ass. I raised a lot of money. I raised billions, but I was good at it. But the second is there's a unique stress that happens with other people's money that you just can't every tick. Like you have to train yourself to deal with it, but it's much worse than your own money. And so I looked at this business. I'm going to say something too that maybe is counterintuitive. I am a better investor and recommender of trade ideas and investing ideas, not managing big chunks of money, because it just freed my brain. I don't have the same psychological impact. I'm not getting caught in those cycles and all that. So your journey is very similar to what I've done. So I want to come to this concept of technical analysis. We're going to talk about our normal format here, where we talk about what are the few things you would talk to, an ordinary person that you meet on the street. But, I wrote a note back in October. I'm going to summarize the note. I sent it to you just a couple minutes ago. I meant to send it to you earlier. But I was thinking about this back in October when we talk about technical analysis. And to me, technical analysis really means the analysis of price. Price is the data that we actually have. So I technically have, earnings data and cash flow data, et cetera, but I don't have the new cash flow data. I don't have the new earnings data. I don't know any of that. And I also don't have data on what people's perceptions are or how excited, how disappointed. I don't know any of that. But what I know is price. And when you take price and then look at the charts and all the different indicators, you begin to understand, you get an analysis of all that data that's in there. And so I used an example of the ocean, okay? In the ocean, you've got the waves on the top of the ocean, right? And we can all see the waves, right? We know what's happening with the waves. But also underneath the ocean is you have the tides, right? These are the super powerful things that are happening that the waves might tell you a little bit about, but you don't know. And so to me, technical analysis is really using analysis of the waves to understand the tides. And I want to come back to one thing that you said that really struck me, fighting the trend. there are so many, and it was your whole story about like you made it big because you nailed one big move. And I'm sure your analysis was great, but you also got a monster move to do it into. The vast majority of the time, the market doesn't do that. And the vast majority of the time, you want to be the friend is your trend. You want to take advantage of it. You want to take advantage of pauses in it. We're going to talk about that in a second. But I'm curious, like if you had to explain, your wife is probably really sophisticated. Your father-in-law, when you first met him and you had to explain technical analysis, how would you explain technical analysis to your father-in-law? Or if that's too loaded, someone that just bought you a beer at a bar, because I don't know how you get along with your father-in-law, but
Yeah, for me, and obviously I've been asked this question a lot. I've asked this question to, some of the greatest technicians, to most of the greatest technicians that ever lived, right? That are alive today. And to me, in my experience, technical analysis is the study of the behavior of the market and therefore market participants that are driving those decisions, right? So it really comes down to understanding human psychology. Price is the only thing that pays, right? You mentioned how important price is. The only way we get paid around here is to sell things at higher prices than where we buy them, right? That's the only way, and not necessarily in that order. And we know for a fact that asset prices trend. We know, right? Asset prices are not random. They might seem random to an untrained eye, but we actually have the data. It's not random. Asset prices trend. So as investors, whether you're a technician or whatever you want to call yourself, if we know for a fact that asset prices trend, as investors, we should probably spend some time, a lot of time, looking for those trends.
Yeah.
Right? And that's really what we're trying to do here. And then understanding that it's not fundamentals that drives asset prices, it's positioning. And understanding the institutions that are perhaps mispositioned, particularly at extremes, that create massive unwinds in the opposite directions, in both directions. When all the institutions have piled in and there's no one left to buy, look out, the rug pull's coming, and vice versa. Like at the end of 22, these institutions were super short. This was after the bear market had already ended. Rather than covering, they were adding to their short positions, and that created a massive unwind throughout 2023. It's not that there was some massive fundamental shift
change,
between the fourth quarter of 22 and the summer of 23 that you had the greatest first 6 month rally in the history of the NASDAQ. It wasn't this massive fundamental shift. It's just that the institutions were improperly positioned. Sell-side strategists consensus had a negative year for the S&P 500.
First time ever and only, probably. So let's talk.
So the opposite happens.
Let's talk about two things you just talked about there. You talked about trends and you talked about trend shifts, or what I call potential. With the trends, you mentioned this. You look at the market as a whole. The market as a whole is the aggregation of the psychology of each individual investor. And, people used to ask me, why does the stock go up or down? And I used to say, well, because there's more buyers than sellers. My old partner was like, well, there's always an equal amount of buyers and sellers, right? There has to be. And so I amended that, and I call it the enthusiasm of buyers and sellers.
Well, hold on. It is true that more buyers and sellers is what drives prices higher. It is also true that for every buyer, there's a seller. Here's the thing. There aren't an equivalent amount of buyers and sellers at every price. You see, so that's price discovery. So yes, for every buyer, there's a seller. It's just there isn't an equivalent amount at every price. That's what's driving.
And I refer to that. That's much better mathematically said than I said. I call it the enthusiasm. When you have that imbalance creates a greater enthusiasm one way or the other. So what I find interesting about trends is, we don't know. So I believe in the human beings use heuristics all the time. Okay, heuristics, simple rules to govern complex situations. We have all these heuristics that govern stocks that we talk about, earnings, cash flow, all this shit. What's interesting though, take Amazon, which is one of my things. We have some simple sayings that we say. One of them, which we'll talk about in a little bit, is plan the trade, trade the plan. That's probably the most important one that I can say. Another one that we have is that stocks are not companies. Okay, there's this idea that when I buy a stock, I own a piece of a company. Well, maybe, but in the short term, definitely not. And even in the intermediate long term, if Amazon has never paid a dividend, has barely bought back any stock, and Amazon has gone up a gajillion fold. Amazon, with no dividends or buybacks or anything like that, stocks are kind of
or earnings.
Or earnings. They're kind of NFTs, right? It's this digital certificate that I own somewhere. But what's happened is, as a heuristic, we look at earnings growth, we look at all these things. So part of it is getting to psychology, both on trends and potential. I have no way of understanding what the aggregate psychology is. I can't go interview Fidelity and interview 1 million market participants, but the price and how the price moves and how it's oversold in the stochastics, they are telling me what that aggregate psychology is doing. And to me, that's the beauty of technical analysis, is that I still believe in the intermediate term fundamentals matter. If something goes bankrupt, obviously it's gonna matter, big cash returns, etc. But in the meantime, we can get a view, if you learn how to read the waves of what market psychology is saying about a stock. And so it kind of builds on what you're saying, both trend and what I call potential. Is I always look, I say there's a raft, and you've got a raft going down a river. That's your trend, right? If all of us go to one side of the raft, it takes very little, or only a tiny rock, for the whole raft to go like this and people get thrown overboard. Then what happens is everyone goes to the other side of the raft. And again, you're still going down your trend, but your potential at any moment for a correction or a reversion or something like that is very high, because human beings all tend to go to one side of the raft where the sun is shining or that they feel is the safest. So.
I mean, I get it. I think this gets back to, like, tops and bottoms are not an event. It's more of a process, right? You could sort of see that shift. The market didn't bottom in October of 2022. The market bottomed in June of 2022. If people would just take the time to go and count the amount of stocks that were going down and the amount of stocks that were going up, by the time the S&P 500 made its low in October, there weren't any stocks left still going down. Most stocks had already bottomed out months earlier. Same thing in 2021. People talk about the top of the market 2 years, at the end of 21, S&P end of 21. By the time that the S&P and the NASDAQ and the Dow put in their final highs at the end of 2021, there was nothing left going up. Most things had already peaked in the first and second quarter, and we're already heading lower. So you could really see the changes underneath the surface, and that's really what technical analysis is all about. It's about understanding that this is a market of stocks. It's not just a stock market. So the S&P has 500 companies in it, right? The New York Stock Exchange Composite is 2,300 companies, whatever it is these days. The NASDAQ 100, Russell 2000. And then what types of stocks represent those indexes? That's also very different. The NASDAQ 100 is not the stock market. It's 50% technology, right? And that doesn't even include Google or Meta or Tesla. None of those are even tech stocks. So when you add all of those things, like that, in the NASDAQ 100, for example, there's no energy, there's no financials, there's no real estate, there's no materials, there's no barely any industrials. That's not the stock market, right? Now you go to the New York Stock Exchange, you got a lot more financials, you got a lot more industrials. You also have half the index are international companies that aren't even in America. So if you're looking at the New York Stock Exchange, you have to understand that dynamic. So each index has its own thing. Like in the Russell 2000, you got 260 biotechs, like another 250 something regional banks. Guess what? If regional banks and biotechs aren't working, the Russell 2000 is going to have a hard time doing well, even if small cap industrials, small cap tech, small cap discretionaries, they could all be killing it, and the Russell 2000 will still be struggling if biotechs and regional banks aren't participating. Like, for example, right? So just understanding the dynamics of what's happening underneath the surface. And if you're just looking at, in isolation, what's happening with one company or with one stock, you're not going to understand the direction of the overall market. And that's really most of the battle, is having the wind at your back. Well, right? I think you don't want to be fighting trends.
If you go to William O'Neill, I mean, one of the first things he says, I'm a huge fan of William O'Neill, How to Make Money in Stocks. I've got a reading list pinned on my website. I think that's book number 2 or 3. It's understand the trend that's behind you. So let's go back for a second. I'm going to put you on the spot here. You're at the bar and it goes, oh, you're that technical guy, right? Technical analysis guy, but they're going to say that technical guy, right? And they say, sure. Define, I don't know if you can do this. I'm really putting you on the spot. I don't know what I would say, so I'm going to think about it while you say. Define technical analysis in one sentence or one brief paragraph. What would you define it as?
Understanding what's actually happening.
Okay.
Right? Because a lot of investors talk about what should happen, or this could happen, or that might happen. But we're focused on what's actually happening.
Right.
And there's a lot of information in what's actually happening because, contrary to popular belief, past returns are in fact indicative of future results.
Right. Yeah, absolutely.
Like asset prices trend.
Yep.
So something that's been going up is there's a much higher likelihood it's going to keep going up. Assets that are outperforming are likely to continue to outperform and continue to do well. If we are seeing more and more stocks participating, that is indicative of higher stock prices. If fewer and fewer stocks are participating, simple math, it's harder for the indexes to go up, right? So the answer, what is technical analysis, is focusing on what's actually happening.
Okay, so perfect. That's great. And I love that. I'm going to use that, actually. I hope you don't mind. I'll give you credit.
Knock yourself out. It's the truth.
So let's say,
for the record, technical analysis is the only truth.
Right.
It's the only truth.
Well, price is the only truth.
It's not, analyst opinions. Right. That's right. And what are we looking at as technicians? We're looking.
Well, no, and I'm going to say what you said before. We don't buy earnings. We don't buy cash flow. We don't buy dividends. We buy a stock. The stock has a price. My goal is to buy it low and sell it higher. That's it. That's the truth. It's funny too.
Or buy it high and sell it even higher.
Yeah. Exactly. Buy it lower than we're going to sell it.
That's right.
It's funny when because our backgrounds are kind of similar. I knew fuck all about Wall Street. I didn't know anything about stocks, anything like that. What I liked about Wall Street, once I learned about it, was the certainty of price. Right, I had so much uncertainty. I had a very tough childhood. I had so much uncertainty in my childhood, and I didn't really suffer from discrimination, all that. But I was a poor kid, living in apartment complexes and buses and all that stuff. But to me, it was like, if you're right about price, you're right. You don't have to convince anybody with anything. Like if you buy the stock at 20 and you sell it at 30, there's no sales process. There's no convincing. It's like that is a certainty. And to a certain extent, technical analysis lives in that world of certainty of price. It's not about opinion. It's about what's actually happened and what can happen. So I think that's right. That's one of the things. So, okay. It sounds like you started your career very young. Let's go when you were 25, 28, 30. And you're now 32, whatever you are.
42.
And you look great. I'd look a lot younger if I shaved the beard, but I like the beard. You go to 32-year-old or 28-year-old JC, and you got 10 minutes, okay? And let's say, obviously, you were sophisticated at 28, a lot less sophisticated than you are right now. Let's say you got 10 minutes to talk to 28-year-old JC. We're just talking about markets, not life and everything else. What do you tell 28-year-old JC about the markets and what he should be doing?
I'd reiterate to just go. I mean, I living in New York City for a long time. I mean, I started my career over 20 years ago. So being in my 20s and early 30s in New York City of all places, if you're in this business, you're gonna have to come to New York at one point or another, right? Whether you live in Europe or in Asia or in Texas or in California.
I lived in New York for 26 years, by the way, Lower East Side, within 6 blocks.
There you go.
Yeah.
So So what ends up happening is that either somebody's going to call me and be like, hey, JC, I'm coming into town. Get everybody together. Let's go have dinner. Let's go to happy hour. Or, hey, JC, so-and-so's coming into town. We're all getting together. We're going to happy hour. We're going to dinner. So every week, I was meeting somebody. I was hanging out with somebody. By the way, a lot of Wall Street people live in the New York area also. Yeah. So you already have a huge community. So I had the ability to kind of just, hang out with, multi-billionaires quite often, and just successful traders, legends from all over the world on a regular basis. And then years later, I started to travel to, Hong Kong and Singapore and Malaysia and Philippines, throughout Europe, Greece and Amsterdam and, London and the whole thing, right? There were some moments that I didn't seize the opportunity and go, and I did a lot of that. I said yes a lot more than most people would. But I would say if I could sit myself down, I would say just go. don't worry about it, because in the future you're going to have kids, you're going to have more responsibilities. You can't just dip to Shanghai for a weekend,
Right.
Like, so I said yes a lot. Those were amazing learning opportunities. There were certain times that I did certain things and went to certain places that I couldn't afford, and I made it work and I figured it out, and I'm very thankful for those opportunities, even though, there was something in my head being like, maybe I shouldn't spend the money, or maybe I shouldn't take the time. The hell with it. Just go.
So let me translate that. Let me translate that into the markets, though. Is that like take advantage of the opportunities you have to learn from others. It's
totally,
yeah,
totally. That's my point in all this. Yes.
Well, and I give the example. Look, a lot of the people that are watching this, they don't live in New York. They won't have the opportunity to meet these people. You and I have both been blessed to have been the opportunities in this business. I actually go back to my reading list of all things. So I went to Wharton, which is a great training ground, all that. But I didn't learn jack all about investing or trading at Wharton. I met great people. I actually learned a lot of it. I learned a lot of it from doing. Okay, that ended up being, unfortunately, the way I did a lot of it. But actually going out and reading Stock Market Wizards by Jack Schwager, reading William O'Neill, reading Peter Lynch, all these. I put on my the thing I pin on my X account, Twitter, is this reading list, because I feel like once you know the finance basics, if you just read what these other people have done, you begin to get it. And then the last one, and I don't want to talk our own book, is find people that you can learn from and trust. Because now, there was no friggin' YouTube or podcasts or any of this stuff when I was coming up. Now you've got people that have managed billions of dollars that are out there, and we still have businesses, subscription businesses and stuff trying to make money, but like it's just readily available. So like I'll take your go and say, go out and learn and avail your, do the work, so to speak. Would be kind of my takeaway or rephrasing of that.
You make a good point. You got to read the books too, right? It's not just about going to Hong Kong and partying with the Goldman Sachs guys. Like that's part of it. But you got to read all of the Schwager books, and when you're done reading the Schwager books, read them again.
Yeah.
Right? Am I wrong? Like, read the Market Wizards book and then be like, okay, that was great. Now you start from scratch and read it again. And, the Edwards and McGee, read the whole thing and then read it again. And get the John Murphy books and read them again. And then, read, right? Sam Weinstein, and read the books and then read them again. And then get Brian Shannon's and then read them again.
I read a ton. Like I don't know that I've actually read a full book in quite some time, but I read all day long. I'm a writer like you. So I end up reading, I blew out my eyes. But I feel there's almost a good discipline if you take those key 20 or 30 key books and just read one of them every 3 weeks. Even if you've read the book 10 times, it just cements it back in your brain, where it's like, oh yeah, I got to remember to emphasize. Okay, so you define technical analysis to the guy at the bar. You gave your first piece of advice to 30-year-old JC, which we're going to say is do the work, go take advantage of the resources. What focus a little bit more on markets and trading. What would be your second and third? But these are big pieces of advice. This is my plan the trade, trade the plan, which to me is just one saying that captures, I don't care if you're investing, whether you're trading. I actually kind of don't care what the hell you're doing in life. Plan the trade, trade the plan fits pretty well. It's like, think what you're going to do, come up with an intelligent plan. You may be right or wrong on outcome, but come up with a good process and then stick with that process, and that's how you ultimately get good outcomes. What would be your number 2 and 3 to young JC?
Yeah, number 1, go for it more. I remember studying for my CMT exams and getting invited to happy hours where certain big producers and money managers, and drinking Diet Cokes and not drinking the beers because I had to go study, right? The CMT technical analysis stuff that we're describing right now, right? And I would be drinking Diet Cokes because I didn't want to miss the opportunity of what we were going to be talking about at that particular happy hour, but I didn't want to get drunk because I had to go read technical analysis stuff later. So, just to reiterate, you don't just have to be boozing. So number 1, go talk to older folks, ask a lot of questions, be part of the conversation, go to the dinners, go travel, go do those things. Number 2, when it comes to reading, 100%, go through all of the books, read them all. What advice I would give to myself? Get to the psychology stuff quicker.
Okay.
Took me too long to realize how important it is to understand the psychology of markets, understanding your own human behavior and your own, the heuristics, if you will, the flaws that we have as humans with as I've gotten older and wiser, this is my 21st year, something like that in the market. I am focusing a lot more on my attention. Instead of trying to be right, I focus more on others being wrong.
Okay.
Right? Charlie Munger, rest in peace. One of the greatest things he ever said was that if people weren't wrong so often, we wouldn't be so rich. Right? That's what he's telling Warren. Right? Like, he's looking at Warren and being like, people weren't wrong so often, we wouldn't be this rich. Like, think about that. So, and I've already done a good job. So you want to, as an investor, I try to find the pain points.
Okay.
I try to find where there's not enough positioning, where there's too much positioning, and looking for those unwinds. And it's easier to bet on others being wrong than it is to bet on yourself being right. It's easier to bet on others being wrong. So I focus a lot of my attention on that.
It's funny is when I started writing this, and our franchise is a very unique space. Like, most of the guys I know that have my background, if they got into writing and research, they're writing for other hedge fund managers, they're writing for professionals. I'm writing for professionals, but people that aren't professional investors. So I really had to rethink it. I found myself I'm a little bit older than you. This is my 30th year in the market. So, I found myself, a third of what I write is about psychology. It's all, it's about, you have your process. Hopefully it's a good one. You come up with it, whatever it is, whatever you're going to do, whatever style you want, just have one that works through time. You go out and you do the work, and then there's going to be outcome that comes out of that. That's a result of what the market gives you. But the key is also have the psychology to be able to fulfill that process and that outcome. Because there was a thing in the hedge fund world. This actually happened to us back in 2002, 2003. We had, we were really good investors. We had a really nice run. And then our returns kind of just got mediocre. And we had a guy pull his money. It was like probably 10% of our fund. It was $125 million. It was Mesereau out of Chicago. They're all gone now. So but I love them. And I go, why did you pull the money? And they said, they're like, oh, we can't really tell you. And I insisted. I flew to Chicago. I said, why did you pull this money? And they showed me something. They said they took what they called steady state portfolios. And this is a little bit for investing strategies opposed to trading, but I still think the lesson sits. They took our portfolio every month. They took then, if we did nothing, and then what we actually did versus the portfolio where we did nothing. We consistently underperformed the do-nothing portfolio. Our active management was detracting value consistently. We took that and said, what are we doing? We literally said the ideas are right. Let's just take what we're doing day to day and do the opposite. And we managed to turn it around where we were now driving value. And a lot of the trading strategies that I do in Trader literally came out of that exercise. Is, our whole thing is we find winning stocks that are in an uptrend with positive earnings revisions. Then we wait for the RSI to go below 30 and pop back up above 30. So the market's given us a little indication. And that's got an 80% hit rate. We made money in 2022 all along with a 76% hit rate. But again, I think it comes down to the psychology of it, right? Embedded in all of that was psychology, and understanding your own psychology and managing it. So if you had to pick a book or two or three, other than following us and our newsletters, a book or one or two or three on psychology, what would you recommend?
Thinking in Bets by Annie Duke.
Okay.
That's a great one. Just understanding humans and sort of evolution. Noah, what's it called? It's called, Noah Jabari. What's his name?
I don't know off the top. I didn't mean to put you on the spot, too. I can never remember the authors of books and everything.
Hold on. This is a super famous book. I mean, Noah, it's,
you can look it up. I have my books behind me.
Yuval Noah Harari.
Okay.
Yuval Noah Harari. There it is. So the name of the book is called Sapiens.
Okay. I don't think I know that one.
Yeah. So that's just understanding sort of, what something he does really well is taking sort of concepts that have already been discovered, concepts that we already know, and he tells it in a very in a much better way
Okay.
than all of these other people over the years. So it's easy to consume. Another one is The Psychology of Money by Morgan Housel. Great book. Again, same thing. A lot of the stories in there, these anecdotes are things that I had already heard before, that I knew already. But he just says it in such a great way because he's such a great writer.
Morgan,
and same thing with Sapiens.
Morgan is amazing. Like he really, and that's actually been, you kind of were in this world. I came from the investment world where there was a lot of great process, but people weren't, there's no writing. You're not built to communicate it. You take a guy like, actually, I'll tell you, Stansberry, where I came from, they did a great job of taking sound concepts and putting it in language that people could understand. I was reading before I joined Stansberry, because I was like newsletters. I was this like pump and dump. Like I didn't know what the hell it was. I must have read 100+ Stansberry letters, and I was like, holy shit! Like I manage money professionally, and this is just bringing to the fore like core ideas that I know, but it just said it in a way that resonated with me and stuck with me. And yeah, Morgan Housel is awesome. Okay, so we did go out, avail yourself of the resources, do the work. Focus on psychology. Do you have a third? And again, mine are plan the trade the plan. Stocks aren't companies. Mine are a little bit more pithy. Yeah. What would be a third that you
blow up? Go blow up as soon as possible. Go blow up as soon as possible, because until you blow up, you're never going to learn.
Yeah.
So you might as well do it, get it over with quick. And many people blow up and they still don't learn. So make sure you're learning lessons, right? You're never right in this business. Because if you lose money on a trade, you were wrong, obviously. If you make money on a trade, you're still wrong because you should have made more.
Okay.
Right? So there's no end zone dances in this business, right? So it's all about learning. Like you nailed the trade. 30% winner, 40% winner, 200% winner, whatever it was. Nice job. Why didn't you own more? Right? It's not like, oh my God, I'm so great, I'm so smart. If you were smarter, you would have owned more.
Right.
So even when you're right, even when you make money on a trade or an investment, there's still a mistake because you could have made more money, right? So, it's about learning from each one of these things. What could I have done differently so that I wouldn't have lost money in that trade?
Yeah.
Or what could I have done differently to lose less money in that trade? Or what could I have done differently to let that winner run? One of the things that we're doing now, for example, internally, is figuring out ways to be greedier, right? Certain strategies that we've implemented in the past, like, when our call options double, we historically take half off the table, kind of just best practices.
Okay.
We're not doing that anymore.
Okay.
We're raising our stops. It's a little bit more complicated, but, we're trying to be more greedy. So we're always working on our game, right?
Yeah.
Like if I'm a basketball player, and I could shoot, from the mid-range, this summer I'm going to work on my three-point shot so I could shoot from back. If I'm not driving enough, I'm going to work on my driving. Oh, my left hand is weak. I'm going to work on my left. Like, there's always something to work on your game. Like Kobe Bryant used to work with Hakeem Olajuwon on his footwork. Like, Kobe Bryant working with the Dream? Like, are you kidding me? Like, to be a fly on that wall. But, like, just to show you, you've got a guard, working with one of the greatest big men of all time on his footwork.
Hakeem was quite the dancer, by the way, though. We got to be fair here. Let's take about that blowing up, because I got a funny story, too. I became a portfolio manager in 97. Shortly thereafter, long-term capital happened. I founded my first firm in March of 2001. September of 2001 happened. I founded my next firm in August of 2008. Lehman happened. We actually launched Empire. So I'm launching my firm here. We just launched the firm here. Empire launched in September of 2019. I actually, because then we had COVID right after.
Sure.
So first off, lesson number one, if I launch something, be very afraid. But
I was going to say, geez Louise.
But lesson number two, that was actually the best thing that could have happened for my career, because I was forced to start in periods of duress. So my ability to protect capital, make money when making money was hard, I kind of was forced into it. And then when making money was easy, I in the beginning, I didn't make as much money when making money was easier. And I had to learn that as another skill. But the keeping yourself in the game, and I think that actually, I'll give you one last like thing that you would say to people, but I'll share a story about keeping yourself in the game. My first job on Wall Street was, I had interned at Lehman Brothers, and Lehman still had partners. And so my last day, the partner at Lehman Brothers takes me out, walk him to his car, which by the way is now Goldman Sachs. Literally the Goldman Sachs building was the parking lot across from Lehman Brothers. So we're walking through
over by Times Square?
No, over by the World Trade Center. World Financial Center. Yeah. So Lehman Brothers was in World Financial Center. So we're walking through the parking lot, which would become Goldman Sachs. And he says to me, he goes, let me tell you my best piece of advice in this business. He goes, stay alive. Stay in the game. He's going to say, I'm going to tell you something. He goes, if you do things the right way, you meet the right people, you do the work, you're going to make a lot of money. But he's going to say, he said, I've got guys that made all their money in the first 3 years and didn't make money again or made money 30 years later. He goes, you're going to walk in 1 year and you're going to say, I am exactly positioned. I'm going to crush it this year. Everything's set up. And he's like, you're probably going to lose your job. And you're going to have another year where you're going to walk in and you'll be like, you know what? Things are good. It's fine. And you're going to crush it. Stay in the game. Have a process, plan the trade, have a plan, stick to that plan. And that kind of gets to what you're saying, that for me, I think learning in those terrible markets was the best thing, right? Because I had to learn during the points that knock you out. And so therefore, most of the time, the market's not going to knock you out like that. Not like 2011, not like the tech bubble. Those are really, really, 2008, which you went through, things like that.
Nope.
So I think there's a lot to be said about learning from that. So last message, if you're talking, and again, our audience, actually, I got to be honest with you. My audience there's a lot of former hedge fund managers that listen to me. There's a lot of people who don't know anything about investing. There's a lot of people that like tattoos and curse words. What would be kind of the last thing you'd share, like one impactful thing about trading, investing? And to me, they're the same thing. There's making money. Trading is a way to do it. Investing's doing it. So I kind of just put it making money. What would be the last thing you'd say?
Yeah, another thing that I discovered, that became more important once I had accumulated actual wealth was, diversification. And I think that diversification is misunderstood. People are like, oh, I own emerging markets, I own small caps, I own large caps, I've got, dividend exposure. You're not diversified. You own a whole bunch of stocks. Right? And, they're all going to move out. It's not diversified at all, right? In my experience, once you have some wealth, having a series of different strategies that are as uncorrelated with one another as possible is real diversification. So, we've got one portfolio that we're just, we're buying every month, right? I got like kids, I got 3 kids now, college funds, the whole thing. You're putting money down every month. You're buying at the lows, you're buying at the highs, you're buying everywhere in between. If the S&P is down 8% or more in a month, we're doubling our positions, right?
Yep.
So that's one strategy. We have another strategy that's long short, right? Long short portfolio, crypto, stocks, options, whatever. Let's go. There's always opportunity in the market. Great. One has nothing to do with the other. We have an option strategy where we're selling strangles every day. We got the top, most liquid 30, 35 ETFs in the United States. Every morning we wake up, we sort by implied volatility. We sell the strangle on the one with the highest, right? What are we getting paid to sell today? GDX? Let's go. Sell the call, sell the put, collect the income. Tomorrow, what's the next? What's the highest implied volatility? Emerging market ETF. Terrific. Sell the strangle, right? So again, just collecting income. It's not going to change my life. It's a more conservative strategy. It is just going to collect income. That's it. And when some of my other strategies are more volatile, because the market's more volatile, or maybe my position sizing is big, I know that is very consistent, right? So having these different portfolios and different strategies, I have my venture capital portfolio. I own multiple businesses that bring me revenue, right? I got different things going on, and I own my house outright, for example. So I don't have that hanging over my head where I got to make my mortgage or whatever. So because I'm more conservative in some of my investments, I can be more aggressive in others.
Yeah.
And my position sizing, where I have certain control over those positions, I'm willing to take what perhaps would be construed as an irresponsible sized position, But within the context of the other things that I got going on, it's not really that big, right? It might be big for that part of the portfolio, but in the whole scheme of things, it's fine, right? So it allows me to be more aggressive in certain areas because I'm more conservative in the others. So again, getting back to multiple different strategies that are uncorrelated with one, as uncorrelated as possible.
Yeah.
Because my real estate investments, my VC investments, my stock market investments, they're not going to move in opposite directions, right? So you're going to have some correlations, but that's another thing that I learned over the years. 4-5 different strategies.
It's funny, and you did this totally unintentionally. You just talked our strategy portfolio of newsletters. We have a trading newsletter that is very uncorrelated, that made money in 2022. We have an income that is somewhat related to that generates income. We've got one called Legacy, which is my old hedge fund strategy. It's more long-term. And then eventually we're going to launch one called Protect, which is what happens when the market goes to hell. What do you do? But it's basically the same thing. And they've actually reacted in 2022. The long-term one got hit really hard. Okay. The trading one crushed it, because it was a great market to trade. In bear markets, trading is awesome because there's huge extremes, right? You get super oversold. And, the best oversold I've ever bought is a bear market oversold. When it gets, because you just get statistics that are like out of this world. Like you've never seen anything like it. But is diversification in the strategies, which is basically what we've tried to build. So, and you did that by accident. You didn't know any of that before, and like it just happened to fit with what we do. So
it's true, though. It's true. That's real diversification.
Yeah,
different strategies.
Great, JC. I appreciate you taking the time. When I was looking away before, I was getting your Twitter, your X handle at All Star Charts. Any other places people should follow you, check you out?
Yeah, you can follow me on OnlyFans. No, I'm just kidding. Twitter, allstarcharts.com. I'm easy to find. Come say hi. Share some charts with me. Give me some feedback. All good.
Awesome. Great. I want to thank you, JC, for your time. And again, everyone, we thank you for taking the time with us here on the HX podcast. Follow us at HX Research. I'm at Enrique Abeda, YouTube, Twitter, LinkedIn, all that crap. So again, thank you, and we'll talk to you soon, JC.
All right. Adios.